We are now live. Thank you.
Thank you, Madeleine. Good afternoon, everybody. I'd like to welcome you all to the 13th edition of the Global UAE Energy Forum. We are right now in the European session of this 12-hour forum where we are circling the globe, starting with Asia and Middle East earlier today, and we've now just started the European session. And I am delighted, and we'll be joined by 50 analysts across those 12 hours. For this particular session, I'm delighted to open with the feature interview with Mr. Melek Yari, who is the Group CEO of NNPC in Nigeria. Mr. Kiari, thank you so much for joining us.
Thank you so much, Diala. Thank you very much for your time also.
Well, it's great to have you and to make the most of our time with you. Let's get going. I'll start with let's start with Nigeria. We're going to be discussing Nigeria and then perhaps delving onto OPEC and OPEC Plus and where that might be going. Again, this is all about the outlook for the year ahead and what you see as the most pertinent points to make on that front. Let's talk about Nigeria within the context of OPEC. First of all, we did have many members of the OPEC Plus coalition last year struggling to meet their quotas for production, despite even cuts being made towards the end of last year. Nigeria, of course, was one of those who was suffering with that. You did have, production problems. There was sabotage on pipelines, etc. Give us a view at the start of 2023, where things stand in your sort of production projections, and whether those challenges are coming under control.
Yes, very well. Thank you very much. I think it's very clear from all market analysis that there is a supply shortfall globally. And of course, nobody is doing much to close those supply gap. Remember, in the last 10 years, there is a massive underinvestment in our sector for very many reasons, some for economic reasons, but mostly associated with energy transition conversation. And of course, this was further complicated by the COVID-19 period where investment came very low and there was no basis for people to put their money into this business. And ultimately, we're seeing the impact of that. And definitely for OPEC and the global E&P industry now, we know for sure that efforts are ongoing for people to bring back money into the capital, despite all the restrictions that we're seeing around the financial sector. But definitely, even if you wish to bring back production tomorrow, you can't do it because that's not how it works. When you bring in money into this industry, we know for sure that you need a gestation period, probably 24 months minimum. And at the best of intention, you can recover production immediately. And therefore, minding all the geopolitical issues, the Ukraine and very other associated issues with it, the fact still remains is that the net production is declining. Companies are making effort to bring back those production. In our case, we have a different challenge other than just the lack of investment in the last 45 years. There are low investment in the last 45 years. That's correct. That's true of very many other jurisdictions where cash flows don't support the investment. In our case, we had a different challenge, a security challenge that became very manifest early 2022. And of course, we took definite steps to bring back production, and this is paying off. For instance, around July, our net crude oil, excluding condensate, came down to about 1 million barrels. That is low in ever the history of our country and our industry. And of course, that has been restored to a great extent because we took some steps, a very practical step that so to handling of all these issues around pipeline security. And this is working. So for us, we see a trajectory of restoring production, including condensate, within the year. Definitely, we believe that we can hit our target of 2.2, but our budget target is 1.8, but we know that it's practical to do 2.2 within 2023, probably by the time of 2023. This is practical. So for us, it's a moving target in a sense that with best of efforts, we can achieve this. So overall, in the OPEC basket and among all production, except for a few jurisdictions, we know for sure that investment today will not translate to production tomorrow, and therefore countries will continue to grapple with the ability to meet their quotas.
Of course, and a lot of pressure now is coming on the OPEC countries, if you like. If you take a medium-term outlook, they're really going to be the ones who are going to be coming up with that incremental production. And as we just said, a few of its members are struggling. But you mentioned cash there and cash revenues. And of course, in 2022, because of your drop in production, you didn't generate as much revenue, obviously, as you needed for the barrels that you were producing, could have produced. The other issue that Nigeria had in challenge was in some of it had to import more fuels, if you like, but what is the trajectory for that going forward, given your forex reserves to be able to continue with those purchases and imports? And structurally, has the fuel situation again improved in the country? NNPC restructured mid-year last year. Has that made any difference to how it's running operations?
Yeah, it did make a difference. Remember that subsidy on fuel is always a government policy decision all over the world, and many countries do them in different ways. Yes, we have a direct network of value from the pump price of petroleum in our country. And in very many other countries, they do, because of the high energy costs in very many jurisdictions, including very many developed countries, they've brought down tax rates, eliminating tax on petroleum and so on and so forth. They all translate to the same thing, some form of a subsidy on petroleum. Wherever you have subsidy anywhere in the world, you do have to manage arbitrage across your borders from your supply chain partners and so on and so forth. So for us, NNPC becoming completely a private company today, owned by government, yes, but it's operating just like any other company in the country, like Shell, Chevron, and any other company they can think of in our country. And therefore, our relationship with government today in terms of supply of fuel is on a commercial basis. There's a service level agreement between us and the government to supply fuel and then sell it at the price that the policy decision of government has asked us to do. So it's not a problem at all for us as a corporate company. It's a value for us. We're delivering products to the country. We have the sufficient cash flow to support this. And there's a relationship between us and government. We don't see any challenge, delivering a product into our country. Man, the fact that, almost a 100% import of our petroleum product requirement because of the very fact that we have decided to rehabilitate all our 4 refineries in one sweep. And it does the right thing to do. We've made a very clear commercial decision to do this. And as soon as we are doing this, of course, as we all know in this platform, a very informed platform, we know that producing locally brings you close to supply, and that removes energy security issues. But other than that, the key impact is actually freight issues that you have to manage. And we are very comfortable with what we're doing now. We don't see any danger in supply into our country. We're meeting all our applications. We don't have any payment issues with our suppliers. And of course, as we're seeing the growing production from the crude oil production and condensate production, that we know that ability to pay will not be an issue for us. So we don't experience the kind of thing that other countries may be suffering today. So I don't see any challenge going forward, but the decision of whether or not the subsidies will remain will clearly be that of government, and we're happy to serve them.
Okay, and just to go back to a point you made, just to get some clarity before we move on to slightly bigger picture, you said that you're hoping maybe 2.2 by the end of this year, 1.8 is more realistic target. Where is production today in January 2023?
We by December, I'm sure I have the current figure for December. End of December, we did 1.519, which is not far from 1.8. And I have a number of projects that I have clear line of sight when they can come on board in 2023. There are restoration works that we're doing on some of our pipelines, which will clearly making the attainment of 1.8 very, very easy to attain. We're looking beyond that. We think that we can escalate it higher.
Okay, I mean, let's talk a bit about that. With these ambitious plans for production to increase this year, hopefully, and of course, that's positive for Nigeria, more revenue. Now, will you be able to export those volumes within the OPEC Plus group? Because, of course, a big conversation to be had, and that's expected to be had within the group this year, is the whole question around baselines, which came into challenge last year. And the reality conclusion at the end of last year was that should any more oil have been needed, which it wasn't, that Saudi and the UAE, for example, would have had to take the slack because the other members weren't ready. Now, going forward into this year, we have OPEC not planning to meet for another few months. 2 questions for you. Do you think the decision they took in October to cut production was the correct one in hindsight, 3 months later? Secondly, do you expect this conversation on baselines to happen anytime soon?
I think, first of all, when the production cut was announced in October, obviously it was based on the data that was available at that time. And then at that point, I recall that there was some gallop in prices downwards. And that may be the reason that they informed this, not that there was visibility of a new production that's going to come up or restoration of production from the asset. I think it was probably a reaction that was informed by the moment. But in today's context, I'm not sure it will be necessary to sustain such costs today because supply is still a challenge. And of course, coming back to my country, around would we be able to send crude oil into the market? We're already doing that, yes, because every production that we do here today, because we're not processing, we're processing very little part of it, except in a few modular refineries. That means that Nigeria is contributing to the market in terms of supply of crude oil into the market. Not 100% of that production, when it's converted to product, comes back to our country. Of course, Nigeria is continuously contributing, despite the fact that today our net both condensate crude oil production is around 1.5 million barrels per day. But we know that we are contributing to the market. We will escalate this. So even when we are able to get back our refineries, combined capacity 450 to 45,000 barrels per day, and then the Dangote refinery, which we believe that could come up on stream by the middle of the year. So national capacity will be somewhere around 1.1 million barrels per day. So you still have a net difference that has to go to the market. And of course, local processing, if we do this, we'll exceed our domestic product requirements. And definitely, we may not be supplying crude into the market, but literally, we're also delivering product into the market because there's a reversal of flow of sales. And that's all that's going to happen. Otherwise, the net national consumption will surely not be 1.1 million barrels in the next 1 year. It will not be so.
Yeah, and what do you make of it? You're talking about the net flows have changed. You're talking about Nigeria specifically in terms of its domestic consumption, what it can then export. But let's just quickly put the question to you of, I don't want to get too much into the Russian question here, but of course, Russia's flows changed dramatically last year because of the war. We saw countries like China and India take more of its oil. And of course, we have product sanctions coming up in less than a month on Russian oil products. How is OPEC, from your point of view, OPEC viewing that change of flow from Russia in terms of its Asian market as a secure demand center? Does it feel any threat from that?
I don't see any threat, because the production levels still remain about the same thing. The market has not rejected production from OPEC member countries. It's really change of flow of trade, and that's really what has happened. Because whenever you have political dislocation like we're having because of this Russia-Ukraine crisis, it did have impact of how much of crude oil is able to leave Russia. But overall, many countries have done some marginal increases, and because the price remains substantially high, consumers have also reduced their offtake. So therefore, that's some kind of balancing that has happened natural. That it has happened because of the factors of demand and supply, and this is very, very obvious. So of course, we have not seen any rejection. We have not seen significant cargo hanging in the markets today. And that means that flow has changed. Of course, into Europe also, great volumes are also still coming into Europe, and of course, countries in the Middle East also have not lost their market in the Far East. That's why the fact that you're seeing some flow from Russia into China and India. I've not seen any significant change to that equation.
And do you think, again, we'll get this view from our panel that's coming up later in the session. Last year, obviously, this price volatility was a big theme of the year for many reasons behind that. And the other one was really, trying to determine whether supply or demand was being pulled more strongly. Literally month to month, the projections, expectations were changing because of the geopolitical situation, because of so many new macro factors hitting the world. But going forward now, for the first half at least of this year, Mr. Chiari, do you see, you talked about supply constraints and shortages generally, but if you look at oil prices, certainly they're not indicating any serious supply constraints at the moment, and that's with OPEC having cut production 3 months ago. So what's your projection for that picture going forward, the demand supply? What will be a bigger determinant factor this year, do you think?
I think one thing is very obvious in the market. We haven't seen this level of gallop in prices in the history of the industry, where you see month to month or week to week changes that are unprecedented. You see losses of $10 in a week, and that's abnormal in this market. And we haven't seen this. Therefore, the whole balance of demand and supply haven't really, in reality, played out in the last 1 year or so. That means that the line of sight around new production limited, ability to bring back oil production is also limited by very many factors, financing, the response of the financial world to fossil fuel investment and so on are really constraining that ability to respond. Therefore, I do not see a significant recovery of supply within the next 1 to 2 years. That means that you're going to live with this range of prices for a while to come. I'm not see how this demand will collapse because countries are coming back. China is recovering from COVID-19, and a number of countries, particularly sub-Saharan African countries, are growing. The economies are growing very, very fast against all odds, and that means that more consumption. And clearly, within the next 1 to 2 years, I'm not sure we'll see any fall in demand. That means that once demand don't fall, and you are not able to bring in new production, or you're not able to restore production, it means that you're going to live with whatever price you're seeing today. That means that seeing a sub $75 to $80 oil is very, very unrealistic.
Yeah, and I mean, that might be good for countries like Nigeria and OPEC countries and other producers, but certainly not a great picture, even if it's $70 or $80, which today is looking low. For consuming countries, particularly, as you said, developing countries, whether they're in Africa, Latin America, etc., that huge burden of cost of oil supply as consumers, debt burdens, of course, with a high dollar, etc. What stress are you seeing on the African continent on that front? Do you think that developing economies can live with $80 oil?
Yeah, it's very difficult to predict that. But of course, what happens is that when prices get too high, your demand goes down. It's very natural. And countries will come up with other approaches to finding energy sources. And that's very, very correct. As you may be aware, in sub-Saharan Africa, our key fuel for transportation is petroleum. And infrastructure for railways are very, very underdeveloped, and therefore you're relying largely on internal combustion engine vehicles for transportation. You're almost left with no option than probably cut the frequency of your travels and all that. But ultimately, demand and supply will come to play, and countries will have to live with it. I know that a number of countries have been issues with ability to even import petroleum products that we're going forward. And I'm sure the market is aware of this. Some of the conversation and engagements that OPEC has put forward is that there needs a balance of pricing so that the consumers are also kept whole and they are not going to any difficulty, while the producing companies also don't lose. I think there's a balance that is happening, and as you may be aware, in the industry, everybody sees a $60 oil is a good price for both consumers and supplier. But whenever you have extreme issues around supply, then you just live around the $75, $80. And of course, this is a key challenge for many African countries.
Of course, and even though Nigeria is a producer, as you said, for the last year, that's been a bit of a challenge for you, because not only have you not been able to reap the revenue from your oil to its maximum, but you had to import products, which of course have also been priced very expensively the last year. And just quickly on that point, before we wrap up, Mr. Chiari, you mentioned the 4 refineries that are coming online this year, which should improve that situation. Is there an updated date on that, when those will be fully functioning?
Yes, well, by half of next year, we'll get one of our refineries, 2 of them to start, and then the third one will not be able to come back by the half of next year. Okay, so for this year, then you would say that there might still be... This year, I'm sorry, I thought we were in December. Apologies, it's this year. Sorry.
We're in 2023.
I apologize. I meant the half of this year. Thank you.
Okay, then okay. Well, Mr. Chiari, thank you so much. We've run out of time for our interview with you. Thank you so much for joining us. Mr. Mele Chiari, who is the Group CEO of NNPC, thank you so much for your time. Please do stay online and join us for the panel session that's coming up now, which will be addressing commodities, but I would ask you to switch your camera off, please. But please do stay on and join us while I welcome our next panel speakers, who are going to be discussing the outlook for commodities in the wake of peak inflation and interest rate tightening. looking forward to our outlook for 2023 on that, all things commodities. And I'm delighted to ask, first of all, our three panelists to turn on their cameras and join us. That's perfect, thank you so much. And welcome everybody, Mr. Ole Hansen, Head of Commodity Strategy at Saxo Bank, Mark Oswald, Chief Economist and Global Strategist at ADM Investor Services International, and Dr. Carol Nachle, CEO of Crystal Energy. Thank you so much, everybody, for joining us. And you can all turn your mics on. Fantastic.
Yep.
Thanks so much. So we're going to be discussing, and thank you so much for joining us again, the outlook for commodities. You know, we may end up focusing a bit on oil and gas, but let's look at the commodity picture in general, and particularly in the context of course, the inflation that we saw develop in 2022, the outlook for where that's going, and of course, the continued policy of central banks in terms of tightening. Again, we don't have to repeat what we all saw last year in terms of where that ended in December. But let's look forward to 2023. And of course, the big key themes of last year, apart from inflation, interest rate tightening, we had a war, and we do have still a war in Europe, pending recession, which has not hit the US yet. In fact, some would argue the opposite is going to happen. And perhaps Europe's recession looking not as bad as people were thinking it would. Ole, can I start with you, please? And let's look again at another big theme of last year, which was volatility across commodities, not just oil and gas, across the whole, you know, that was the name of the game really, across commodities in 2022. What can we expect for the year ahead? Is that, you know, volatility index going to calm down in any way?
Well, I would certainly hope so, because what we experienced last year was clearly not good, neither for producers, consumers, or traders. It was a very, very tough year with the massive surge at the start of the year, and then the market showing increased volatility also on the downside later in the year. So I think we're getting to the end of some of the unknowns, which will reduce some of the volatility. We're seeing inflation having peaked, starting to come down. The big question now is obviously where it's going to land eventually, and I think that's obviously a key question for the year ahead. I think we are doubtful that we're going to reach the low levels that the market is anticipating. That can create some volatility in the investment metals, but generally the oil market is I think we're not seeing the kind of risk of spikes and peaks and troughs as we saw last year. One major uncertainty is obviously, looking ahead, it's going to be the pickup in China. Obviously, I know there's been a lot of talk about China all morning and into the afternoon, but obviously that is a major force that will determine some of the directions of these commodities this year.
No, of course. I mean, in China, we have, of course, talked about it in our Asia section earlier, but it is the one factor, isn't it, where for fundamentals at least, it still remains the sort of marginal center of demand. Carol, let me go to you, Dr. Carol Nachle, on that point. Another theme of 2022 was this yo-yo of sort of being, is demand destruction or supply, you know, shortage, etc., going to be the main challenge, and we saw that shifting a few times. What's your, and let's think about that then, because, you know, it's reopening, and so that's going to play into the game very much this year. If we can look at it, you know, is it going to be a year of two halves? That's again something that a lot of people are talking about in terms of fundamentals and what the expectations on how producers and markets should prepare for that.
Well, yeah, I don't believe in these halves or quarters, because you know, if you have a crisis or if you have economic developments, they will not start at a particular time of the year. Now, there are two things I would like to highlight here. First of all, when we're talking about this year, are we comparing it only to last year, 2022, or are we comparing it to the pre-COVID period? Because don't forget, we are still recovering from the pandemic and related policies. So really, what time frame are we comparing to say, are we going back to normal? Are we going to have a boom? Are we going to have this and that? So that's something to take into consideration when we're looking at the outlook for this year. And the other thing is that I'm finding some kind of disconnect between the financial community and Wall Street analysts and what international organizations such as the IMF and the World Bank are saying. So for example, you see many analysts from Wall Street and other financial community, they downplay the issue of recession, the outlook of recession. You know, they perhaps overplay the comeback of China, its positive impact on the economy. But then you go and you see statements by the IMF, statements by the World Bank. They are actually painting a very gloomy picture for 2023 on the economic outlook, the macroeconomic outlook globally. I mean, the IMF, not long time ago, I think 2 weeks ago, they said a third of the world economies, including the US, China, and the EU would be in a recession this year. Of course, nobody knows how deep that recession is going to be, and they're not going to start at the same time. So that's another thing. And they don't know how durable, if that recession happens, it's going to be. And the World Bank also says that 2023 is going to be actually worse than what we saw in 2022, economically speaking. So I'm not going to talk about, you know, halves in terms of periods, but halves in terms of this kind of dichotomy in the perspective that we currently have at the beginning of the year, which is actually an indication of the level of uncertainty that we are still facing this year for all sectors, including energy.
Okay, Mark, I mean, on that point of sort of obviously the unknown, you know, we're facing a lot of maybes and ifs and a buts, but let's talk about inflation, which is in the title of the session, and peak rate tightening. You know, hawkish I suppose, brakes on activity, supposedly. But we didn't really see, and despite quite high oil prices and energy prices last year, gas and oil, the demand destruction didn't really set in, did it?
I think that's debatable. If you look at the countries, say, like Germany, clearly production in the industrial sector has actually come back. You know, it's come back down, not as much as energy consumption. So there is an element here in countries like Germany, whereby we are actually doing something which everyone's praying for, that people will find ways to economize on their energy usage. The only problem within Europe, obviously, is that united voice that there was immediately on the outbreak of the Ukraine war is simply not there anymore. It's gone up in another puff of smoke, as the EU often does. I think that the key point here, though, is we still, you know, even if we benefit from energy prices being at an overall lower level, they are higher than they were a year and a half ago. And secondly, we still have all the problems with the lack of investment, the lack of infrastructure in Europe. You know, it's all very well people saying, oh, yeah, well, we'll just replace Russian gas with LNG. Well, the LNG requires completely different infrastructure, and it requires, particularly in terms of distribution. So all those problems haven't gone away, and all we need is another shock. And, you know, I think the lesson of the last 3 years, through the pandemic, through the Russian invasion of Ukraine, is very simply one that if anyone says, oh, well, we're getting back to normal, you probably need to challenge that assumption. And secondly, that if we do have another shock, then we're going to go back into this whole issue of our supplies are basically very constrained, and that above all applies to product. And I think in terms of China, just going back to that, perhaps the thing we need to look at most closely with China is this balance between, you know, if they're still exporting a lot, that actually doesn't send a great signal about their domestic demand. And that's a metric I think people need to, you know, exporting product, this is, that's a metric people need to keep a close eye on.
Well, let's just stay with you, Mark, on that, just on that, China. So are they still exporting? They had a blip where they started to re-export. They allowed more quotas to refineries at the end of, you know, the last quarter. Is that continuing still, or have we seen a pause, you know, given that we're having now the whole economy reopening as well happening?
Well, what we're getting now is this whole issue that we had in Europe and North America when we started to reopen, that with the surge in COVID cases, you're getting a lot of disruption. So to people getting to work, particularly in the more manufacturing, processing businesses. And that's just going to be a stop-start process, at least through the beginning of the second quarter, if not a little bit longer. So a lot of these metrics I'm talking about, you do need to take a longer term perspective on it rather than saying, oh, from week to week. And I think this is really what Carol was mentioning about financial markets being so fixated on short term real-time metrics. And that's probably not a good lens to look at a lot of this through.
But Carol, just to go back to that on the financial markets, yes, and they're, they wanted maybe to talk up their own books, if you like. They've had enough last year. That's enough slowing down. Thank you very much. But in terms of the outlook, in terms of Fed policy and how the European central banks may follow suit this year, and obviously how commodities are looking at that in terms of obviously demand for those products. Has the commodities market sort of fully absorbed now what it kind of more or less the range of inflationary expectations in the year ahead and rates tightening? Last year was complete question mark. The year ahead surely is a bit more certain.
Well, there seems to be today a greater belief that because inflation seems to be easing in key economies, whether here in Europe or in the US, therefore central banks are going to kind of relax their the increase in interest rate. But that is, I think, questionable because, and again, I'm going to quote the IMF. I mean, we need to wait a bit longer to say for sure that we have hit the peak of inflation. I don't think now I can stand here and then tell you with confidence that inflation has hit a peak. We would like to see, a little bit longer and definitely more sustainable decline in inflation rate that hits also the wages, for example, in key economies such as the US and in other sectors, not just food and energy. And that is, we are not there yet where we would say that, okay, now we can say for sure whether we're going to see a change in the monetary policy. It might happen, but at the moment I can see still determination, at least with the Fed in the US, in Europe with the ECB, that they are going to continue with their interest rates until they have more definitive evidence that we had hit peak inflation, not only peak inflation, because mind you, are at very high territory, to go back to Mark's point, than where we were only a few years ago. They have very much more ambitious targets to bring inflation down, and that is by far mission accomplished today.
Okay, I mean, Ollie, let's talk a bit about sticking to sort of financial policy and think of the US dollar. Boomed last year by all intents. Sure, a bit of weakening towards the end of the year, a bit of adjustment, but obviously against other currencies, it was still way ahead. Your bank has talked a lot recently about, is it time for a different reserve currency in terms of even commodities trading, especially oil? Outlook for the dollar in the year ahead, what could be influencing that, and how that could also then in turn influence commodities demand?
Well, looking at the weakness we've seen so far this year has been primarily driven by, I would say, the Japanese yen, the euro, the Aussie dollar, and the Chinese renminbi. And it does again highlight the trajectory that the market is trying to price in for the economic recovery in Asia, and what it has and what kind of impact it has on neighboring countries, and obviously also that we're seeing a change at the helm of the Bank of Japan later this year, and that may also signal a shift in their stance towards their interest rate policies. So that's been aiding the dollar weakness, but generally we do see the dollar weaken further over the year, but still a little bit hesitant about the first moves that we see at the start of the year. That quite often they tend to be a little bit exaggerated because investors are putting fresh money to work, and that's driving some of these movements that we're seeing right now. But generally with the interest rate trajectory in the US still pointing higher, but at least starting to slow. And with the market still firmly believing that inflation is going to get under control, that has also led to some of the softness we're seeing in the yield market. So it really all depends, and that's also very important what Carol said about the inflation. I think we have seen the peak, but are we seeing inflation coming down to the level that the market is pricing in? That's really where the concerns are, because we still now got the second or the third move coming with wages and so on. We're going to see some very tough negotiations across the world. People want to have a higher higher income to offset the price increase we've seen. And if that leads to a renewed focus on the yields, then obviously the dollar could strengthen again. But generally, I think we are past the point of dollar weakness, but just a little bit hesitant about calling it sharply lower from these levels. I think we will need some consolidation where we get some further views about the developments on inflation and obviously central bank intentions.
Okay, yeah, and I'd like to come back to perhaps later on in the conversation about the dollar and its impact, of course, on developing economies and the whole debt question, because that, again, obviously played its part last year, but the real pressure on specifically the poorer countries with those high levels of debt perhaps hasn't started to manifest, and how could that impact, again, demand for commodities? Mark, just back to you, let's talk about, we are in the European session, so let's talk a bit more about Europe. Per se, you mentioned before you touched on gas. We're gonna talk about Russia now, oil and gas, and the outlook for how that's going to impact those prices in terms of what possibly might happen. Mark, let's talk about gas. This winter, by all intents and purposes, Europe again was kind of okay in the end. You know, warm weather, they reduced consumption. The US came to the rescue with a certain amount of LNG that Europe could take on. And everyone agrees that next winter will be the challenge, et cetera, et cetera. So two questions on that front. You know, how is Europe going to resolve the fact that it's okay at the moment, but it has got to think about storing and stocking up for the next winter? And the part B will be to talk about, again, that link to Asia. You know, Asia suffered because Europe took a lot of the gas this year from the US. How is that going to impact Asia if we have a repeat of that?
Well, in terms of Europe, I think the important thing here to think about is that companies are basically going to be dealing with the fact that their energy prices are going to, you know, they may come down, but they're still going to be overall much higher. So this is the sort of residual inflation impact, which I think people above all are not really taking enough account of, whether you're looking at the equity markets in the US, which look hopelessly overvalued when one thinks of wage pressures, these residual inflation pressures. And then within Europe, yes, I think the fundamental issue here is still, how do they get something in place in the long run? And this is really where the sort of problem of disunity amongst the EU is manifesting itself, as we saw at the back end of last year. I mean, it is actually ironic that probably the most sensible price cap suggestion came from Greece, but everyone rejected it because it came from Greece. Well, what's wrong with a Greek suggestion? If it's a sensible one, it doesn't matter who it comes from. But it also shows that sort of fundamental tension there. And I think the other problem within Europe is this fact that we've got fragile governments everywhere. The German government's fragile, the UK government's fragile. Mr. Macron has decided to take another bite at pension reform, which always basically goes down like a lead balloon in France. Yes, it does need to be done, but at this moment when he's in cohabitation, as they like to call it, it's not great. And there needs to be more because what I'm saying is there's a lot of expenditure still needing to be done. A lot of governments have got very expensive energy support measures for the public and for businesses and what people are forgetting in terms of the inflation outlook is, if we do see a more permanent drop in oil and gas prices, then those governments are going to, like the UK government is already looking at, going to withdraw some of that, so that the downward impact from energy prices, yes, you may see it in the wholesale markets, but you won't be necessarily feeling it as a consumer. Now, in terms of Asia, I think the biggest positive here, obviously, we'll see how the rest of the winter pans out. I'm not as confident that we're through the worst yet. But in terms of Asia, the biggest positive is really that China is reopening, because I don't think necessarily China reopening is such a positive for Europe and North America, but for the rest of Asia, particularly Southeast Asia, China reopening could actually be a major, major positive. But it also means there's going to be a lot more demand, not just from China. I think we need to look at East Asia as a whole, and then also consider that the Indian economy is actually still performing very robustly.
A lot of people are saying, yeah, it's a story of three. It's a three-part story in Asia. You've got China, you've got South Asia, Southeast Asia, which is looking positive, and a couple of countries like Japan or South Korea, which aren't looking so robust. But Karen, let's talk a bit about that in terms of global flows, and let's come back to Russia and the Russian crude and gas. We saw sanctions and price caps come in to play at the end of mid-year, and then again at the end of the year. And now, of course, we've got product price caps coming in next month. Everyone said, well, sanctions didn't bite as much because, of course, the redirection of flows. What's to say it's going to be any different this year?
Well, look, I mean, sanctions do work and they do bite, but not immediately. So they are, if you want, like a diesel engine. They take time for us to feel the impact. And therefore, the longer they are in place, the more we are going to feel, at least Russia is going to feel the impact of those sanctions, especially if you keep on, piling them on top of each other like a souffle. But in the other weakness of the sanctions, that's why we did not have a big impact, is that not everybody joined the sanctions. We know pretty well who has imposed those sanctions on Russia, and but there were half of the most important customers for Russian oil, and maybe increasingly for gas, but I would say more so for oil, are not taking part of these sanctions, and that by itself weakens further the impact of the sanctions. Now, with oil, it was pretty much easier for Russia to redirect the flow. So more of it was going to Asia, more from Middle Eastern oil was coming to Europe. And that's the beauty of a global market. I know we were expecting perhaps a horrible crisis in Europe and the weather helped in terms of gas, but at the end, we forget that prices, markets work. Customers and suppliers respond to prices. Demand weakened in Europe because of price signal. Supply increased to Europe because of price signal. My only problem in Europe, particularly as Mark said about governments being in trouble, is that when governments feel squeezed in these democracies, they end up taking irrational steps and imposing and announcing irrational policies. So that by itself can distort the mechanism by which you would expect a crisis to be resolved and extended further. But going back to the sanctions for gas, the price cap, I'm not quite sure it's going to be, and it's not really a sanction, it was a policy measure. But for oil, I would say there is, what I'm still getting my head around is the impact of the sanctions that will become effective as of next month, which is on products. And the reason why I'm saying this, because with crude oil, I think there was a consensus about market observers that the impact was going to be minimal because of this redirection of the trade flow and crude going to big consumers like China, India, Turkey, and even some countries in the Middle East. You could see that going in that direction. When it comes to crude products, so to oil products, the picture is not the same because countries like China, they need crude to refine. They do have massive refining capacity. Are they going to also buy products when they have the capacity to refine the crude? The same thing for India. So I'm still not quite sure whether I can again say with confidence that yes, with oil products, the impact is going to be the same. I think at some point we should expect to see Russian production declining, maybe not severely, but again, last year the range of expectations was pretty high. I think at some point I even read 5 million barrels a day. This did not materialize. But for this year, even if I look at the most modest forecast that is coming from OPEC primarily, they are expecting around 850,000 barrels a day. So I think, and that could be the result because of Russia unable to redirect the same quantity of oil products, and as such, they will be forced to reduce a bit of their production. So it's still a gray area for me in terms of impact. It's unclear as it was with the sanctions on oil, crude oil.
I mean, you mentioned OPEC then. We won't get too much into OPEC in this session, but as far as commodities and prices go, and inflation, because they were being slapped on the wrist a bit last year when they cut production. The world's already under great stress. What are you doing? You're supporting high prices. And they seem to say, well, we need the revenue and sayonara, you know. In terms of this year going forward, the move they took in October seems to have been, you know, in hindsight, the correct one. That it hasn't, you know, prices in fact have come down. So their forecasts came true, if you like, at least in the short term. Where do you see a continuation of to the wait and see policy that they've been doing month on month? And secondly, their relationship with Russia, is that not going to get too complicated this year, given what we're seeing in Europe with the war?
Is it for me?
Yes, for you.
Well, look, I mean, I know that I think that if somebody like OPEC is not going to get better at forecasting oil market than many of us out there, then I don't think anybody really knows market makers, because they are involved, you know, day and night in this. So they definitely have a good perception. I want to go back to what they did last year. I think the condemnation for what they were doing was primarily the timing when they had this controversial announcement of 2 million barrels a day. It's not whether it was right or wrong. The timing, the optics of it raised some eyebrows and some question marks, and then some, you know, led people to say it was politically driven, even though it was based on fundamentals. But I find very difficult to distinguish between politics and economics in oil markets globally. And I'm not talking only about OPEC. In terms of what they will do going forward, so far, again, I'm looking at what they published in December in terms of what they see the market going. They don't expect the market tightness in the same way as they expected only a few months ago last year. But actually, they see that there will be more supplies coming to the market. They still highlight the three main risks for oil markets, and they summarize them as China, the outlook for China. I know everybody's getting super excited about China, but are we certain that everybody's going to start spending their savings as if there is no tomorrow, and they will start traveling everywhere, and Chinese politics are going to become super friendly? Or are we going to see more of an openness in one side, but on the other side, the government to save its face and to maintain control over its people and the economy and politics? There will be some oppression increased elsewhere. I wouldn't take that for granted. And the second factor, so there's a Chinese factor, there is the economic factor, and of course, China would fit perhaps under the economic outlook if you want the global economy. As we discussed earlier, are we going to sail through a mildish recession? Are we going to see, you know, if China opens up and everything's going to be okay by the end of the year and everybody else is facing a recession? Will that have an impact on the market? And the third factor is geopolitics. The war in Ukraine is still ongoing. Can you tell me now how it's going to be over or end, or when it's going to be over, and what kind of repercussions we're going to have? I don't know. I think it's too early to reach that conclusion. And as somebody once recently told me, you cannot win a war against somebody who has nuclear weapons. So these are the three main factors that are quite rightly on OPEC mind when looking at market fundamentals for this year, the outlook of prices, but at least they don't see a tight market, at least for the first maybe quarter of this year. And then I don't know, it's very difficult to tell what will happen for the rest of the year.
Yeah, and I think many people are making the assumption, at least in their forecast, that the war is here to stay. Only just back to you, I want to talk a bit about that in terms of, I mean, at the beginning of the war in February, March, you know, from an inflationary point of view, food and other commodities, not just oil and gas, you know, are obviously spiked, and we haven't really talked about that today, but let's address that in terms of that conversation around food prices, although inflation is everywhere, and the panic around actual fundamental supplies coming out from Ukraine and Russia, etc., to East and West. Where is that? Has that calmed down a bit? Have we seen that supply chain of food recover? And is that playing at all into, you know, what may be a new, I suppose, commodities super cycle as one element of it?
Well, I think Russia and Ukraine was the main reasons, obviously, for the spike that we saw back in March. But Russia and Ukraine has also been the main reason why we are now coming back down pretty hard, especially on the wheat, because we had a record production year in Russia last year, and they are selling it. They're selling it quite at a rapid pace right now. We still got the grain corridor supply, getting supplies out of Ukraine. Up until recently, obviously, we had a weak or strong dollar, which was also preventing U.S. farmers from competing. So there's really been a lot of flow coming out of the Black Sea area. So at this point in time, I think the coming season may be less challenged, or hopefully less challenged than the one we had last year. Also, simply from the fact that the gas price has come down, so that means the input costs towards the fertilizers, as an example, has come down as well. Diesel costs are coming down, even though they remain reasonably elevated. So that will support a decent production year. So once again, we're left watching the weather. So far, we have a few problems with drought in Argentina, but generally, it seems like it's been a better start to this season than what we saw last year. Even places like India, where they're again talking about a good crop when you look at wheat prices. So generally, I don't think the super cycle, if that still can be used as a word, I think probably can. It's not going to be one of the engines, the agricultural engine. Perhaps it's not going to be as forceful as we've seen over the past year, and obviously that's something we can really only just hope for because of the importance.
And what about, just sticking with you, please, Ole, just before I go to Mark for the 1 or 2 of the final questions. Gold, we haven't talked as a commodity of sorts and a currency, I suppose, in a way. That's had a bit of a recovery, having been very boring the last few years, relatively speaking. Again, is that just because Bitcoin and everything else collapsed halfway through the year, or what's the trajectory for that, and against the dollar, if you like, as a reserve currency?
Well, right now, quite a lot of the lift that we're seeing both in copper and gold is driven by the dollar weakness we've seen here at the start of the year. But generally, I think there is a general expectation for a much friendlier investment year for investment metals in 23. And we have to remember last year when gold finished the year in dollar terms almost unchanged. It was actually a phenomenal year with incredible headwinds from the stronger dollar and from the massive surge in bond yields, especially real yields. And the fact that we had a disconnect between real yields and gold, which at one point actually said that pointed to a gold being $300 overpriced, is the fact that we've seen quite a strong demand from central banks as well. Last year we had a record amount during the first 3 quarters, and we've just seen recently China buying up as well. Quite forcefully in November and December. So what we're missing right now is our general investment demand from ETF investors. They have not really been showing any signs of getting involved just yet. So far, I'll say the rally has primarily been driven by short covering and obviously the positive technical momentum that we have right now. I believe gold will move high. I think we will see a record high, and we believe that inflation will not come down to the 2.2, 2.3, 2.4 that the long-term, short and long-term inflation swaps are pointing to, and that would be the reason why you would be wanting to have investment metals in your portfolio. But as I said before, quite often just be a little bit careful about the first moves of the year. They can often end up not. Well, potentially sending the signal, but not being the right timing. So I'm a little bit cautious at these levels, but generally I see investment metals higher during the year.
Yeah, and of course they started high in the beginning of 22 and then took a bit of a hit. Mark, let's go back to the inflationary sort of argument, but also the debt argument. One reason that people say that the only way the US has to inflate its way out of its debt burden, as do other countries, and that's why we're seeing these policies. But let's talk a bit about whether that's going to be a policy that you think will be continue to be pursued for that reason. And the second one is, the impact again on developing emerging markets and how they're going to cope. With the continuance of a strong dollar, and what impact is that going to have ultimately, if at all, on demand? Are we going to have both developed and developing markets take a demand hit this year, or could we see opposing forces?
Well, in terms of the US, I mean, Ole basically hinted at it already. I think the biggest problem that markets will have in terms of this enormous rally that we've seen recently in bond markets after a very bad year last year, admittedly. And to me, there's a little bit too much consensus. It was so bad last year, it can't be that bad this year. Well, it won't be necessarily that bad, but it doesn't necessarily mean that it'll be good. I think the big problem in terms of the global debt picture is Governments are still running huge budget deficits. There's an enormous amount of debt which needs to be refinanced, both in government and in corporate terms. And that's at some stage is going to place a strain. Now, in terms of the developing world, we already know that there are debt crises in multiple countries. We've seen Sri Lanka, Lebanon, Egypt's got a huge problem. There are many countries in of sub-Saharan Africa with some serious debt problems. And I rather think this is going to crystallize a lot more this year simply because of the sheer volume of refinancing which needs to be done while governments keep on adding to their debt piles. And as much as there will be more demand for bonds because they offer a much better return now. So that, that is the sort of the counterweight to it, that they are much more investable, and in theory, they are less volatile. But I still think there's going to be a big challenge, and I think the problem in the developing world with all this debt, particularly as the inflation problems aren't probably going to ease enough for them in as much of a hurry, is going to become much more of an issue as the year carries on.
Okay, well, yeah, I mean, again, so many variables out there for us to watch out for. We're going to have to wrap up, but just before we do, I want to ask each one of you just to give us a guess at where you think, again, a lot of people have said the oil price scenario going forward this year is going to be more a question about not where's the floor, but where's the ceiling going to be, and quite a few people are quite bullish. So Carol, I'll go to you first, then Ole, and then Mark. Where would you put your cap on? I mean, again, so many variables, but given what the year we've just had, and bringing policy into account, would what would be your cap on oil prices for the year ahead?
Yeah, Diana, you're putting me in a very awkward position because you're forcing me to do something I don't usually do at all. But really,
give us a range.
Cap for what and for how long? We're talking about a daily volatility because our prices can go anywhere they want and as high as they want, and then go as low as they want. So really, I mean, just giving you just a number to answer the question for the fun of it, I would say 120, but I know I'm wrong. I'm telling you from now.
Okay, and again, I mean, we had a $50 range last year, didn't we? So, Ole, if you don't want to give me the top, you can tell me the range.
Well, I think there's definitely a flow under the market for various reasons. The most important one being OPEC Plus and their ability to maintain price stability at least to the downside. So, but I think the first quarter is primarily sub 80, and then as we move towards the second half, we'll settle into a $90 to $100 range. I'm struggling to see it break much higher than that. I think we just heard the Nigerian president there saying that they could see quite a big increase in production there. We just saw the EIA yesterday also raising their production forecast for this year. So there will be supply enough for this year, but lack of investments in future years is still a key concern that will keep prices elevated in years to come.
Okay, and Mark, last but not least.
Yeah, I mean, I tend to agree with the idea that we're sort of in the 95 to 100 area might be the cap for the short term, simply because of the extra supply. But that is very much just for this year, and I'm still really rather more concerned about oil product prices rather than anything else. I don't think crude supply isn't really the issue. Product supply and the outlook for product demand is probably a far more important issue, particularly in terms of the inflation outlook.
Yeah. Well, thanks very much, Mark Ostwald, Ole Hansen, and Dr. Carol Nackley for joining us on this session for Commodities. This is actually the last session for our European cycle, if you like, of these 12 hours of the forum, and actually we're going to be going on to the Americas next, both Latin Americas and the USA. So, we look forward to everyone joining us for those sessions starting in half an hour after a short break. Thank you so much, everybody, and Happy New Year again.
Thank you.
Best of luck.
Thank you.
Thank you.
Thank you.